during stock bear markets, with occasional little interruptions here and there, gold has traditionally gone the other way because it's during those times that the Fed panics and tries to defend the paper assets that are breaking. And the chief beneficiary of that is gold, the monetary metal.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for September 25th through October 2nd, 2023, while supplies last. This week we feature two different specials, fractional eagles and British sovereigns. We have 1 10th-ounce gold eagles at $39.99 over melt and 1/4 ounce gold eagles at $59.99 over melt. We also have King George British sovereigns at just $49.99 over melt. First, the gold eagle was released in 1986 and has been one of the most popular gold bullion coins in the world, providing incredible recognizability and investor trust. The 1 10th-ounce and 1/4 ounce eagles are additionally sought after for their high degree of flexibility and liquidity. Like the 1 ounce eagle, the 1/10 and 1/4 ounce eagles are 22 karat gold strengthened with copper. They're 1/10 and 1/4 of a troy ounce respectively, and come in tubes and boxes at quantity. The 1 10th-ounce gold eagle is just $39.99 over melt, and the 1/4 ounce gold eagle is just $59.99 over melt while supplies last. They're also IRA eligible. Next, the King George British Sovereign is one of the best-known historical coins around. The British Sovereign contains 0.2354 troy ounces of gold and was first minted in the 1400s. The King George Sovereigns continue this tradition between the years of 1911 to 1932 and are prized for their fractional weight and their historical merit. They are priced at $49.99 over melt with a minimum purchase of 2 sovereigns. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back.
Well, it's great to have you. I did want to discuss the precious metal markets today as we're getting quite a beating as we record this on Friday. Your perspective on what is happening?
Well, I think at Momentum Structural Analysis, we stress to investors in any given market, it's best, especially in this day and age, to look at other major markets that are impacting your market. Don't just look at the day-to-day of your market. Quite often, in other words, don't just look out the front windshield, look out the side mirrors, because what's going on out there could be very important. Right now, we happen to think, and this is not always true, by the way, this correlation, that the recent collapse in the T-bond market, and it was a collapse, okay, it was a crash-like event. We pre-called it a nuke event, okay, that would cause a major one, it's in coincidence with gold now. It's trending with gold. In other words, as bonds went down in price since basically a high in April, okay? Gold started down from a high monthly close in March and April, just below 2,000. And bonds collapsed. Gold didn't collapse. Gold is eroded down about, we closed 1999 at the peak monthly close. So, we're 7% lower, okay? Bonds have collapsed. Now, I think when the bonds turn up, and I think they will, and there's not, part of the reason for that is that the Fed doesn't really control the long end of the market. They control the short-term stuff and they have their balance sheet. But when the long end of the market collapses like it has and rates shoot up, that panics them. I recall very vividly that last year, prior to the October low in T-bonds, or the high in yields, it was a very sharp drop. We got bearish in late 2020, and bonds collapsed and collapsed and collapsed. And last October, they made a pivotal low that we predefined as a bounce point. But just prior to that low, during that process of collapse, Yellen was panicked. She expressed herself at numerous interviews and so forth that she was very concerned about the, quote, illiquidity in the bond market. She has not opened her mouth during this recent crash. Nobody from the Fed has expressed fear or concern about it, and they know they should, because you literally have crashed the bond market. If you look at a price chart of gold daily and a price chart of T-bonds, you'll see that the bond market's gapping down, much like some wild commodity, okay? And gold has been eroding down over that same period of time since March, April, in sync with bonds. Now, I think the reason that we're in sync with the bonds this time around is that when there's a perception out there, especially among major asset managers, the Fed has gone too far. This event in the bond market is not something the Fed wanted or Treasury wanted at all. It is evidence that they're not in control. They may control the short end and be incremental and so forth, but that front end, that long end has crashed. It will have consequences. This is the biggest market in the world from their perspective, the one that must be defended. And when it crashes like it recently has, it no doubt has caused much concern among major banks. If you look at price charts of Bank of America and Citicorp, for example, two big to fail banks, part of the Fed club, as it were, they're at multi-year lows. In fact, Citicorp is, if you close the month about where it is now, it's a new monthly closing low for the last 7 years. That's a monthly closing low. It's also taken out the price lows of the last 3 years, yet nobody's talking about the big banks. Well, this debt market crash has no doubt unnerved many of the big bankers, and it's unnerved the Fed, but they cannot say anything about it and have not expressed concern like she did over a year ago. Now she hasn't, and I can't figure out why. Yes, I can. She's panicked. This market is too big to crash. It has implications for the economy, implications in all kinds of ways. Gold is an anticipatory market. It doesn't follow Fed speech. It's not some little market that is pushed around. It's the oldest market out there. It's like 3,000 years old. It's been money for that many years. Whereas most of these markets that we're talking about have been around 100 years. Okay. I think what gold is anticipating is that the policy of the Fed over the last, since March of last year, when they started raising rates, is going to end. There's no issue about it because we now have a bond market crash. They can't jeopardize that situation by further rate rises. They can't express their concern, though, because if they do, that admits fear and failure. So I think that's why we've had absolute silence on that. But smart money, I heard Ray Dalio the other day on CNBC, for example, expressing these same views that we've been expressing. And that is, this is too big to ignore. This is a debt crisis coming. The Fed has gone too far, and now they know it. If that's the case, then gold knows that back to easy monetary policy is highly likely to begin to occur soon. And therefore, that is the bread and butter of the gold market. The erosion of the value of the underlying unit of the money because they liquefy the system and create river flows of excess. They're about to have to revert back to that whether they want to or not, whether they express it or not, and gold knows that. Now, recently, yes, gold has been weak. In fact, it's been a redundant selling process. There's a gold chart that I sent you that sort of explains it all. This is a price chart. Now, normally we at Momentum Structural Analysis, our prime focus is on the momentum action of a market. This is gold going back in price to its bear market low in late 2015 when it dropped down to $1,050. The first little green arrow you see on that price chart is an upturn in February of 2016. We put out our first major buy signal on gold. We'd been bearish all during the bear trend, 2011 through 15. But in February of 2016, we had a sufficient upturn that said it's over, bull market beginning again. At that point in time, you'll notice something on the price chart. Between the mid-2016 rally high, which was up in the high 1300s, so it was 30% rebound off the lows, gold went into a range for a couple years. Up in the mid-1300s, back down into the low 1100s. Mid-1300s again in 2018, back down into the high 1100s. Coming up off that second low in late 2018, we have another green circle, and that's when MSA issued another major buy signal. Price then went up to the top of the range again, which is highly unusual. You don't see, especially in the history of gold, if you go back 50 years or so, gold doesn't make double tops. No major peak in gold is ever a double top or a triple top. The 1976 bull market peak was a single peak at around 200. The 1980 peak was a peak above 850. You never came back to it. Once you dropped, you dropped. You didn't come back to the high. And again in 2011, we made a peak over 1900. And though it tried to hold in early 2012, it never could even approach the high again. So whenever you see behavior in gold where it hits a high, hits a high, hits a high again, it's going through it. Okay. So it did. In fact, in early in the summer of 2019, gold broke through that red line, broke through the top of a price range. Momentum already argued that it would, that second green circle. And gold shot up. And ultimately by 2020, we went up to $2,070 peak. At that point, gold did sell off, but you'll notice the arrows that I've got there define a range that gold has been in since the 2020 peak. Now, every price chart is just looking at this same chart because it's simple and therefore everybody sees it. What happened late last year is the following. We had two peaks up there, the same level, summer of 2020, March of 2022, again with the knowledge that gold doesn't return to its old peak if it's really a top. Okay. After that second hit up there in March of 2022, it came back down, and you'll notice the lower red line is defined by four pivotal lows, all in the 1670s, perfectly horizontal floor. Once we approached that floor, we bounced off of it in mid-2022 and then crashed through it in September and October of 2022. That's when we dropped down close to 1600. But at that point in time, every price chartist in the world that was putting out a gold letter said, gold's over, it's no good, it's going to 1400, going to 12 or whatever. It's just going down, it's no good. Why? Because it broke a floor. The problem was the history of gold demonstrates that it never tops with a double top. And sure enough, when it broke that floor, it was what we predefined would be a bear trap. What's a bear trap? It's a false price chart breakout that sucks in the bears and flushes out the weak longs. It didn't go but 3.5% below that lower red line, the 1675 level. It got to 1613 and exploded back to the highs again by early this year. So again, a third time back up into the upper 2000s. Now notice the difference this time. Now we've got a triple top up there. I use the word top, but it's a pending breakout. Again, gold doesn't top with double tops or triple tops. It's a setup for a new move. Look at the behavior at the first top in 2020 and look at the behavior in March of 2022. Once you made those highs, you precipitously fell. There was no hanging around. It just dropped. Okay. Supply overcame demand immediately. Look at this time. We had our peak close back in April, May, June, July, August, September. Now, we've had 6 months or so of downside pressure, and we're only back about in the middle of the range of the last several years. So the tonal behavior of this sell-off, despite the fact that this month at the tail end has dropped below the 1900 level and spooked some folks, I understand that. But when you stand back and take a breath, deep breath, and look at what's happened really over the last 6 months, it doesn't compare to the drops we had from the 2020 high or the 2022 high. This has been more of an arm wrestling match, meaning there's some demand here that is evident in the nature of the drop and that it's not a collapse. There's another green arrow you'll notice. The green arrows indicate points where MSA issued major buy signals. But after we made that low late last year in September, October, coming up off the 1600s, when it crossed back over 1700, our momentum work, not the price chart, said, okay, it's over, we're going back up again. And sure enough, within a handful of months, we're back to the highs. No particular headline caused that. In fact, the Fed was raising rates all during that time as well, and yet gold went back to the highs. Now, recently, over the last 6 months, T-bond market has literally crashed. It's gone back below its October low of last year. Gold's October low of last year is in the low 1600s. So yes, while gold has been under pressure while the bonds have collapsed, hardly the kind of pressure that the bonds have been under. So it's in sync in the sense that it is pulling back with bonds. And I think when bonds turn up, and we think that is imminent, it's quite possible we saw the low this week, in fact, we think there'll be a short covering rally in the T-bond market, meaning yields are going to drop back down again. This is going to be an impressive rally, we think, in the T-bonds. I think the main buyers will be the Fed trading desk, unannounced and undeclared, and a lot of large asset managers like Ray Dalio's of the world and so forth who see this as an oversold market, the bond market, see that the Fed cannot continue on their current course. They can't even bluff about it anymore. And therefore, Gold will be refed its justification for resuming its bull market, namely easy monetary policy will follow. And therefore, I think you're going to see a sharp counter-trend rally in the bond market, particularly as we see the stock market continue to weaken, especially in the fourth quarter. Not a crash, just continued weakening. And that will cause asset managers to want to move what? Money into asset categories that aren't so weak. And if you look at gold compared to the S&P didn't go back to its 2022 highs. It's lingering in the bottom half of its range. T-bonds are oversold. There's some justification to put that money into that normal traditional category. And gold has behaved quite well compared to other asset categories. So I think you're going to get an upturn in the T-bonds, meaning a brief counter-trend rally and a drop in yields, reflective of a Fed rethink. And gold is going to be invigorated by that. So right now we're looking at the gold sell-off as a intermediate corrective process, not as deep as the 2020 or the 2022 drop. And we think it'll snap back probably coming in this coming month. We've got some specific numbers that we need to adjust when we get into next month, but they're not far above the current market. Right now, these gold's about to become front month. It's 1870. We've got some numbers in the 19 teens and the mid 1920s that say it's over, going right back up again. So we'll alert our subscribers in that regard. But we don't see the gold sell-off that we're seeing now as a beginning of a big crash. You had your crash. That was last year, and it was a fake out. It cleaned everybody out of the market, blew the bottom out of the gold market, and it was a bear trap. You think it's going to happen again? No.
Now, as for the stock market, it does seem like it's rolling over again. Your perspective on where we are there?
We think we argued back in early 2022. We got bearish on NASDAQ and S&P in January and February of 2022. It was very reflective of the 2000 bull market top, when we called the top in January of 2000. And the market labored for the rest of 2000 around and slightly above where we said, get out of the market. Okay. That was the dot-com peak. Okay. It didn't go down. And by the way, during that time, prior to the 2000 peak, the Fed had been raising rates and the stock market went up. Gold market had been under pressure through 2000. So when the stock market was peaking, the Fed paused. It was in May of 2000. And the stock market still floundered, didn't go down, but they paused. And finally, in January of 2001, the Fed actually started cutting rates. We were barely off the high then. The big bear market had not really started in the stock market, but they started cutting rates. And as soon as they started cutting rates, the stock market started to go down heavily. Never crashed, just a good, sharp decline, month by bloody month. During that same period of time, make note, gold bottomed and went up. From 2000 to 2002 and actually to 2011. But while the stock market was having a major bear, 2000 to 2002, the dot-com collapse, again, NASDAQ went down 80%. Gold went up large percent, went from like $250 up to $500 or $600 on its way to $1,900. So don't be concerned about a stock market top. That does not correlate to gold. If the stock market goes down, it simply means there's a major asset category that investors are now, oh my gosh, we thought it was going to recover. We thought it was going to be a soft landing. Once they perceive that it's not been that, and already some of them are with the recent weakness, I think that's when you'll get more money moving into the categories that are behaving better or that are vastly oversold, like the T-bonds. And if you look at a gold chart, the S&P doesn't look like that. It doesn't look so copacetic, going back to a high 3 different times. We suspect that the S&P may try to have a fight around the 4,200 level. And this week we got the 4,240. It's back to about 4,300 right now. So the initial part of this rollover is not likely to be precipitous. It's still likely to be what we call an arm wrestling process. There are levels down closer to 4,000 on the S&P. Now, remember, its low last year was 3,500 S&P now. We think you get back down around 4,000 and you'll start to see more precipitous drop. In other words, the perception that the soft landing is a reality, and by the way, that's a term they used in 2000 as well. It wasn't invented this time. there'll be a perception then around the 4,000 level on the price of the S&P that, it's really failing. And we've got some momentum levels there that say, you're going to start picking up speed on the downside. Right now, we still view it as an arm wrestling process. We've probably seen our secondary highs. Remember, S&P peaked above 4,800 in early 2022. Its high this year was 4,600. Now we're trading on a rally at 4,300. And we think about 300 points below here, the S&P will pick up speed. But if you're a gold investor, don't be concerned about it. Because again, during stock bear markets, with occasional little interruptions here and there, gold has traditionally gone the other way because it's during those times that the Fed panics and tries to defend the paper assets that are breaking. And the chief beneficiary of that is gold, the monetary metal.
It seems like it'll be probably terrible timing for the Fed because we're also seeing energy prices increase, oil increase, which will just impact inflation more. So how can they justify any sort of reversal if inflation is going crazy?
They have to defend the government debt. Their primary role is to defend government debt and the ability to the government to fund itself. If nobody's buying the bonds, or most countries are divesting themselves incrementally over time of the bonds, then somebody has to defend it. And I think the Fed and the Treasury will have to come in and defend it, meaning they're going to have to buy the bonds themselves and print the money to do so. And just like BOJ has been doing, hasn't done a lot of good, but anyway, that's just the fact that they have to defend the government bond market. Consider this other fact. Tax revenues last year were not what they were expected to be. And of course, it's bleeding obvious why they weren't. You had a very unprofitable year in terms of capital gains. The S&P lost 20 some odd percent in 2022. NASDAQ lost 30% in 2022. T-bonds lost like 30% in price in 2022. Real estate lost like 20, 30%, the real estate ETFs. Gold was unchanged last year. It was at 1820 where it closed 2021. Right now we're in the high 1800s. So gold is holding steady during this time. So as this process unravels, the Fed is going to have to implicitly, and they won't make big, broad statements about it because then it will indicate alarm, and they can't afford to indicate internal alarm. That's why it's so conspicuous to me that while Yellen was panicked last year and said she was concerned about illiquidity in her bond market, she has not opened her mouth this time around, because if she did, it would indicate internal panic. And they want to continue their bluff. But I guarantee, and other asset managers know this, the Ray Dalios of the world, that the Fed can't do it anymore. They have a crashing bond market. So that, I think, is ultimately fuel for the gold market.
And as for silver, what are some of the price points you're looking for to reignite the move to the upside?
Silver is interesting in that now it may break those lows, but as gold has come down from its highs above 2,000 early this year, it made a low above 1,900, rallied back up in the high 1,900s. It came down, made a slightly lower a couple months ago than that prior low. So zig, zig, zig. This time it flushed out both those two prior lows, a downward zigzag. It's like been three waves. By the way, three waves is quite conspicuous. That third wave better be a disaster, because if it isn't, that's all you get. Okay. So it's had three probes lower. Silver hasn't done that. Yes, silver's under pressure, but silver right now is around 22.50 last I saw. Its prior two lows of the last several months are down closer to 22. So despite the pressure in silver, it hasn't managed to take out its prior two lows, corrective lows. Of course, its low back in February was under 20. It was a very sharp drop. It dropped from like 25 under 20. But since then, it popped up to 25, 26. And has had repeated sell-offs that are redundant. In other words, it's the same price levels you saw a couple months before. So it's really not trending down. It's trending sideways in broad swings. Right now, it's in a downswing. So I would say to bears in gold and silver, you better make something really good out of this sell-off, because if you don't, this is your last one. As far as numbers on silver, I would suggest a back up around today's highs on a weekly close around 23.50. Should get your attention, indicate that the recent pressure is over, and especially above 24.50 anytime in the next quarter. That those are indications that any lid you think there is on silver is going to come out. In the case of gold, I think the numbers are in the low to mid 1900s. That it says, okay, if you thought this recent drop was the one that would kill it, then this is your last chance, bears. And if you get back up in the low to mid 1900s again, your chance is blown. Gold's going to reassert itself back toward what? What could be a quadruple top price breakout. That will wake up the ever bears. They'll say, oh my gosh. Yeah. And so, but momentum will speak before that, well before ever getting back to 2070 again. But anyway, I think that's right now we're looking at one of these situations where the panic in the bond market has also been in sync with the recent pullback in gold, not collapse. And then when the bond market turns up, and we're already seeing evidence of that now, and we've got some numbers that go into effect next month, new quarter, new month, momentum numbers, that you get TLT, for example, which is a very active 20-year plus T-bond ETF. A couple points above where it is right now, it's starting to break out via some momentum metrics, not the price chart. But I think that could create what you might call a V bottom in the T-bonds. No, it's not going to be a sustainable rally in the bonds, meaning if yields start dropping, it's just a counter trend rally in bonds and a contrary drop in yields. It's not going to sustain, but it could be impressive. And I think during that process, that's when gold's going to get a breath of air and be in sync with the upturn in the T-bonds this time. And except different, gold will be far more dynamic.
All right. Well, fantastic. Thank you, Michael Oliver, for sharing your insights today. If people are interested in learning more about your work, they can go to olivermsa.com. Tell us a bit about that.
Well, you'll find my email address there on the site. And if you'd like to have some sample reports, I'd be happy to send them to you. Again, we cover all four major asset categories because you've got to look at what's going on with the bonds in relation to gold, in relation to stocks, and also to some extent Forex, although Forex really isn't that important for the gold market. A lot of people look at the dollar index and like it's a big deal, and it has some correlation to gold from time to time, but it's not a major place to be looking. But still, we provide an assessment of all four major categories so you can put the pieces together.
Fantastic. Any last thoughts before I let you go, Michael?
Yeah, watch the next week or two in bonds and gold. If we start to see recovery, no, not gold. I have to go back to 2050 or anything like that, but a couple points in bonds, 20, 30, 40 bucks in gold. This process of attempted breakage in gold is over with. You had your chance last year to break it. You broke it. Okay. Didn't go anywhere. Remember that. Okay. So any hiccup back to the upside now, I think gold's going to reassert itself. And the top of that box you see on price, gone.
Fantastic. Well, encouraging words for all of us in the precious metal market. Michael, thank you so much for joining us today.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.